Hi, good afternoon and good morning, everyone, and welcome to Kpler's sixth webinar. Today, we are going to be having a look more specifically at what we're seeing happening in the US markets. A quick intro today in our session. Myself, Alex Booth, will be hosting. Otherwise, you have Alex and Omayun based over here in Europe, and Reed will be presenting from Houston. We also have Kevin in our team who's based in Singapore, and he was joining our panel this morning. Just a couple of things to mention before we kick off. So don't worry, your camera mic turned off by default and your participation is anonymous. We will be sending out the slides in a follow-up email, and feel free to share those as well. And if you have any questions as we're going through the webinar today, please feel free to ask us. You can just click on the Q&A button. If we don't manage to get through all of the questions that are posed today, we will look to follow those up as much as we can as well going forwards. If you are viewing this via YouTube on the live link, if you email research@kpler.com with any questions as you go through, then we'll pick those up and we'll be able to answer those as well. So we'll kick off, and Omayun will be starting. As I say, we're going to be looking primarily at what we're seeing from the US and the way that the export markets have changed across all those commodities. But to start off with, we are going to look more at the kind of a quick intro into the global oil markets, what we're seeing with OPEC, what we're seeing from a kind of an inventory standpoint, because that helps to set the tone for what we're seeing in the US as well. So I'll hand you over to Omayun.
Thanks, Alex, for the introduction, and hi to everyone. So, as Alex mentioned, although our webinar today focuses on the US, we still thought it'd be good to give a quick overview of where we stand in terms of global oil supply. So basically a quick check of how much oversupplied the market still is. So as you know, a lot of oversupply has been taken out of the market thanks to OPEC plus cuts and marginal supply decreasing elsewhere as well, such as in the US, which we'll see later. But actually, so what we have seen is that this fall in supply has translated into a big decline in oil and water. But despite this, we yet to see big draws in global oil inventories, including for storage. So looking at OPEC plus exports compliance to the April deal really sped up in June to go past 100%. So for the month of July, we're estimating compliance at around 133%. That's what you can see at the bottom right of the table here on this chart. So this means that while OPEC plus pledged cuts of 9.7 million barrels per day, we've actually seen cuts reach almost 13 million barrels per day so far in July. I mean, as a reminder, our methodology, we're looking at variation in oil exports, as well as changes that we see in onshore storage tanks, whether that's at refineries or facilities that can be considered as SPRs. Now, high compliance from OPEC Plus was mainly made possible thanks to Saudi Arabia and Russia. So both OPEC Plus leaders still remaining above 100% compliance. As you may know, Saudi Arabia decreased its pledge from the 1st of July by 1 million barrels per day. So that decrease happened from 3.5 million barrels per day to 2.5 million barrels per day target, which was actually the original target. So they had pledged an additional self-imposed 1 million barrel per day cut between May and June. Now, however, while Saudi Arabia is able to bring back this 1 million barrel per day of oil into the market and still remain fully compliant, we've only seen their exports boost by about 420,000 barrels per day. So about half of what they were supposed to bring back to the market. So that's why our compliance estimate for Saudi remains very high, as you can see on this table, around 136%. However, in reality, July production from the kingdom could have been higher, especially due to Aramco burning more crude during summer months to satisfy power generation needs. So as you know, it gets very hot in the kingdom in the summer, and basically to meet that peak power demand, historically, Aramco has been burning a lot of crude directly. Now, in May, that crude burn reached a reported 400,000 barrels per day, and it's expected for that this 400,000 barrels per day double in July and August. But it's also worth highlighting that thanks to new gas projects that Aramco has brought on stream in the past few years, that need for crude burn has actually decreased. So we could see the lowest crude burn this year in years in Saudi Arabia. And nevertheless, this is still going to impact their production. And that's really thanks to two big gas projects in the northern Persian Gulf, which take 3.5 billion cubic feet per day of gas from fields shared with Iran. Now, apart from Saudi Arabia and Russia, the emphasis over the past few weeks really has been put on what the media has called the laggards. So countries that typically do not deliver a lot on their cut pledges. But here I think it's fair to say that if OPEC Plus has been able to be fully compliant, and even more than that, so about 30% more than planned, it's really, again, thanks to these laggard countries as well. So I'm referring to countries like Algeria, Angola, Iraq, Kazakhstan, and Nigeria. If you look at the right table here on the right, you could see that the minimum compliance number for that group of countries stands at 68%, and that's for Iraq and Angola. Now, even though exports from these countries have come down, I think it's still hard to expect that they will deliver on their pledge of compensating for lost compliance. So, that was the big focus of the latest OPEC Plus meeting in June. Some of these countries have pledged to continue cutting more than what they had initially targeted in order to compensate for what they have not done in May and June. And I think this is not really expectable from these countries, especially countries like Iraq or Angola, which desperately needs oil revenues to simply to pay their government workers. So same holds true for Angola and Nigeria. We're not holding our breath here. Unless there's a sort of cash agreement with other members. For instance, a few weeks ago, there was an announcement that Saudi Arabia granted Iraq with a $500 million loan. So it's simply, you could almost translate this as Saudi Arabia buying compliance from Iraq. So this could be a way for OPEC Plus leaders, and especially Saudi Arabia, to kind of save face here and make others comply even more. Now, from the 1st of August, OPEC Plus is supposed to ease its production cuts originally by 2 million barrels per day, but again, with some of these laggard countries pledging to cut more in order to overcompensate, it should be a bit less, should be between around 1.5 million barrels per day. So this question brings us to the more general question of oversupplying the market and how balanced the market is right now. Thanks, Alex. So the easing oversupply, mainly triggered by OPEC Plus cuts, obviously impacted oil and water the most. So on this chart, you can see net oil exports being down for the third month in a row. So net oil exports, just to give a quick definition, it's basically how much oil we see leaving ports with a destination versus how much discharge we see during that same month. So we can see that this has been negative for the third month in a row, and it's showing that the situation is improving, and this has grown to minus 3.5 million barrels per day in July. So again, primarily a consequence of deepening compliance from OPEC members and less supply leaving the shores of these countries for export markets. The number of loaded vessels as well is returning to normal levels. So that's the orange line that you can see, declined by almost 200 since April. By the way, this could have this obviously has impact on freight rates and potentially stock prices of tanker companies. So if you look at some of these companies like Frontline, Nordic American Tankers, TK Tankers, Scorpio Tankers, you can see that their share price really struggled lately, and that's a result of this more tankers being available for oil companies. However, what this chart is also showing you is that this equilibrium is still very fragile. We're not at all back in a world where we need more supply. So we're just getting back to kind of normality. So the coming easing cuts from OPEC Plus could actually disrupt that market stability that we've seen building since June. So it really depends on how quick OPEC Plus will bring some of this supply back to the market. Now, if we look at global oil storage, that also confirms that the equilibrium is very fragile. Although the picture really starts looking more positive again. So we're finally seeing draws in both onshore and offshore storage. So in the first half of July, we have seen draws of about 2.3 million barrels per day. Again, in just the first half of July, that's both in onshore tanks and in floating storage. But as you can see on the chart, we are still at very, very high for both kinds of storage, both onshore and offshore. And on the previous slide, we saw that oil and water has been decreasing, as you would expect, thanks to lowering supply. But what we are seeing here is that floating storage actually is struggling to really clear off. So it's come down a little bit, but it's still very, very massive. And specifically looking at this floating storage issue, we can see that a lot of this is sitting off the coast of China, as there are logistical issues that prevent these tankers to discharge. So for China alone, it's about 75 million barrels that is waiting to discharge in China. So 75 million barrels, it's more than a third of total global floating storage. And that's really because if you look at onshore inventories in China, we've actually seen these continue to build. So it's about another 15 million barrels that have been building onshore China since the beginning of July. So again, we are indeed entering a more stable market, but demand is still far from being high enough to allow a lot more supply to come back to the market, as we can see here in storage continuing to be very, very high globally. Now, on this point, I'm going to hand out to my colleague Reed, who will more specifically look at U.S. markets.
Thanks, Humayun. Yeah, so I'm going to be focused in on U.S. liquids markets today, looking at both import and export flows across both crude and clean products, with a particular focus on the fact that we've seen an improvement in departures in July after a lot of weakness in earlier months as COVID-19 initially hit the scene. So if we look at our first slide here, this focuses in on monthly U.S. seaborne net oil exports. And you'll notice it's no surprise, net departures, obviously net oil exports are just exports, less imports, have grown far more positive over the past few years. This is no surprise, given the fact that domestic production has increased and the fact that domestic U.S. refiners have taken a lot less crude from international markets over the past few years. Now, you'll notice that net departures managed to hit nearly 800 KBD through March and April. Pretty impressive, and quite a difference from just 4 or 5 years earlier. But this reversed significantly into May and June, with imports again outpacing export levels. And then we have seen a flip again into July, with exports once again slightly outpacing imports. Now, there are really two reasons that we're going to look at. that are pretty obvious. First, oil exports have managed to pick up again in July, and imports have kind of come back after spiking through May and June. So if we move forward and look at first the U.S. oil export picture, you'll notice that, in June, seaborne departures bottomed out at around 2.7 million barrels per day, and we have seen a bit of an improvement into July. Departures are back up in a range near 2.9 million barrels per day. And this is really a result of two factors. First, overly weak refinery throughput against year earlier levels is helping to push some of this oil into international markets, because you don't have domestic demand for these barrels being produced here in the United States. And obviously, this is aligns with the fact that you've had an improvement slightly in domestic production, which the EIA reported at 11.1 million barrels per day last week, up from around 10.5 million barrels per day in mid-June. So we have seen, again, an improvement in production and continued weakness in refinery throughput. And that's really helped to push departures higher into July. Now, where are these barrels going? We've seen a big increase in volumes towards Europe, actually, into July, and this is largely a result of flows into Italy and Spain. Departures towards both of those states are up by some 250 KBD month over month, combined total towards both states. And so it's interesting. We have seen obviously a reopening in Europe, and they've helped to kind of drive demand in recent months. Now, you'll also notice, as everyone is very interested in this U.S.-Chinese trade flow, a lot of a record amount of U.S. crude flowed to China in May. 1.14 million barrels to be specific. And Alex Booth will touch on this a bit more later, but China was actually pretty important in providing an export market in April and May, when you really didn't have much demand anywhere else in the world. So that's an interesting development as well. Now, let's go ahead and move forward, and we can look at the import side of things. So obviously, as I mentioned, into July, we've seen net exports move back into positive territory after remaining negative through May and June. This, you'll notice here on the import side of things, an initial spike through May and June, which in arrivals, which helped to push that net export number back into negative territory. And this was a well-reported story in that Saudi shipped a whole lot of barrels to the United States. And this pretty much single-handedly pushed U.S. imports higher against levels earlier in the year. Through May and June alone, arrivals from Saudi Arabia averaged 1.23 million barrels per day, which was more than double the 2019 average. So there was indeed a lot of barrels that arrived from Saudi. And this really did help to push net imports to exceed or push imports above exports for 2 months. But into July, this has started to change. As you can see in the chart on the right, arrivals are down month over month in July. And specifically, imports from Saudi Arabia are holding at around 530 KBD, which is a lot closer to the 2019 average. So again, we're starting to see a return to normality in terms of import levels. Now, of course, just keep in mind that there's going to be a lot of flux around this market, because there's still a lot of uncertainty around, one, what domestic clean product demand's going to do, which means that U.S. refinery demand for domestic versus international barrels still faces a lot of uncertainty. So again, this is we have seen imports kind of drop off, but this is going to be really dependent on, well, what does domestic production do? And also, what does domestic clean product do over the next few months? So just keep that in the back of your mind as you're looking at these numbers. And speaking of clean products, obviously, no surprise, the United States has long been a net exporter of clean petroleum products. And you'll notice, you can see this in the green bars on the chart to the right here. But pretty incredible. I mean, you'll notice in May, departures, net departures down to 467 KBD, clearly a result of a drop in export volumes, which are the blue bars in the graph to the right. I mean, obviously in March, departures were way off even levels from 2 months earlier. In May alone, clean product exports finished at just 1.27 million barrels per day. I mean, unprecedented in terms of export weakness. And actually, let's focus in on that in the next chart here. You'll notice, or in the next slide, this is just a focus on U.S. clean product exports. And here it's clear, right? I mean, you'll notice just how much departures dropped from just normal seasonal levels. And this was largely a result of weakness in Latin American demand. U.S. Gulf refiners rely heavily on Latin American demand to drive sales of clean product exports. And it is only when we have seen an improvement in demand in Latin America that departures have managed to slowly trend higher off the May lows. Now, you'll notice departures towards Mexico have been quite key. And you'll see that in the black line on the graph, but also departures towards Brazil have been key as these countries have reopened, or in the case of Brazil, didn't ever really close. But again, more people are driving. But I want to caution, when you look at these numbers, we are still off really seasonal norms. And there are still a lot of questions around, the long-term viability of, well, I'll say medium-term viability of LATAM markets. I think the recovery for clean product exports to pre-COVID levels is going to take a long time, because you're going to have an initial reopening, you're going to have that initial flush of demand, but it's going to be, for each additional barrel of demand, it's going to take a little bit more work to get back to that pre-COVID level. So it's important to remember that, yes, we've seen a big rebound, but I have big questions about whether this upward trend can really continue in earnest for the moving forward. So this is just, again, focused on U.S. liquids markets. I'm now going to hand off to Alexander Ondler, who's going to talk about LPG, LNG, and bulks.
Yes, thank you. So actually, we'll start with the LPG, as the picture is a little bit better, and it looks that the U.S. producer faced less issue to find customers, as we can see on the chart, and that concerned I think almost all the regions. So if we read through the chart, we can see that the departures did trend lower between April and June before bottoming out at 0.70 million tons, but that was still well in the range we had since last November. So what supported that rebound are a couple of things. So first of all, in Asia, the propane market is locked into a contango with low terminal fees right now, and in addition, the freight rates continue to fall. So the Asian naphtha market is tight, and the widening with propane discount to naphtha supported the move for those who have been able to process propane to partially switch to LPG as an alternate feedstock. We had also the PDH demand for propane, which remain strong, and it's actually expected for China to increase total output capacity to over 7 million tons per annum by the end of this year, which of course means demand for propane from less conventional sources. But also you had some good news in Europe, as the LPG demand, particularly on the propane in Northwest Europe, is increasing as petrochemicals crackers turn to propane as a feedstock, thanks to the substantial discount to naphtha. So as a conclusion on this one, on the LPG, the picture is much better and is not specifically linked to one region, which make it less fragile. And there could be further support later this year also, as PDH plants, which are not so far commissioned, could start later this year or maybe early next year. If we move now to the US olefin exports, so here we wanted to highlight two things. The first is the picture for all installation. So you can see that the export increase with new infrastructures and increase to China as a destination, which you can see with a black line. There has been a notable increase at the end of June, and so far it remained high in July. And one of the installation which supported that increase is the Morgan Point, which actually is owned by Enterprise and Navigator, and that's one of the points we want to highlight on this slide. It's a terminal which is alongside the Houston Ship Channel and has a capacity of 1 million tons of ethylene. So for now, ethylene is being stored in an underground well at Mont Belvieu, and it's delivered through loading docks by a pipeline. But that will change. There will be a refrigerated storage tank which is currently built, and that is expected to arrive by Q4. And that will change the picture in terms of loadings. And thanks to Kpler functionality, it's easier right now to see this kind of increase. You have a full visibility into flows from Morgan Point and other terminals globally, and of course in real time. So far, year to date, ethylene exports from Morgan Point have amounted to almost 200,000 tons, which extrapolate on an annual basis is more than 350. But as I said earlier, that should probably accelerate thanks to the new refrigerated storage tanks, which is currently built, and we'll see at that time if it's below or above the market expectation. Now we can move to the LNG and coal. So unlike LPG or crude or clean product markets, the LNG departures from the US continue to struggle. That's quite clear on the chart. We are probably close to a bottom for a couple of years, almost at the same level as in 2018. So the US LNG is expected to finish at 1.1 million tons, which is a decrease of 2.2 million tons compared to a year ago. The LNG utilization of those plants has collapsed from 90% to just 32%. We still have buyers which are right now canceling cargoes for September's loading, and that's due to, of course, a global gas demand which is weak around the world, but there are fewer cargo canceled than what has been the case in July and August. So the exact number of cancellations is not known. It's probably between 15 and 25, which is just to give you an idea, almost half of the cancellation from July and August, which were between 40 and 45. So it looks like that September cancellation are driven by very weak prices, especially in Europe, where the gas storage tanks were full, and it's not yet clear whether demand in Asia this winter will rise significantly. But as said, what is interesting here is the trend, and cancellations are lower than what it has been the case earlier. But according to our understanding, it's more linked to traders' expectation for November and December more than really real facts that we're already seeing on the market. As you can see, there has been some installation which has been more hit than the other one. So the majority of cargoes for September's loading, which were cancelled, are coming from Cheniere. So it's namely Sabine Pass in Louisiana and Corpus Christi in Texas. It has already been the case for the previous months. So the flexibility of the LNG contract, such as allowing cargoes to change the destination, helps customers to manage their energy portfolio while still providing to Cheniere reliable cash flows. So it's really interesting to see that there are some installation which are much more hit, and of course here we're speaking about Cheniere in the US. So as a conclusion, nothing really good for the LNG, excluding that it's not as bad as it was the case this summer, but it's so far only based on expectation rather than on fact. On the call to finish on this one, it has been also very weak. Of course, the power generation around the world has been very low. As a result, for the US, the coal production is decreasing almost to a 57 years low. For the US, it's a decrease of 30%. So you can also see the installation which hit some of the companies like Peabody or Contura or Consol Energy, and that's probably the player that has been exporting coal to India, which was one of the largest importer of coal, and decreased significantly its imports from the US. And I think in July we're almost close to zero for India. So departure in July are set to finish close to 3 million tons, and that will be a decrease of 1.7 year on year and 3.3 if we have a look on March of this year. And now I hand over to Alex to speak about US and China.
Thanks, Alex. So we just wanted to round off with a slide that we thought would be interesting when we were initially thinking of a subject matter for this webinar, but then given the events over the last few days has just become ever more pressing. And it essentially summarizes in the one chart what you've seen across kind of the presentation as a whole, looking at US exports. And that is kind of the state of play between US to China energy commodities flows. Clearly, the standout here is the July arrivals of crude oil. Now that ties back to what Reid was saying around the significant volumes that were exported earlier on this year, shipped from the US to China. That ties in with the incredibly low flat price that we saw kind of in the run up to those loadings. So what we see for arrivals in July, we're looking at kind of 5.3 million tons. That equates to about 1.3 million barrels a day due to discharge. And as we move through into what we're seeing for August as well, because that flow isn't yet finished, we're seeing another 2.9 million tons, or about 700,000 barrels a day due to discharge in August. So even if the oil kind of doesn't push through, it doesn't kind of manage to discharge in July, there's still a significant amount that we're already seeing for August as well. So the 2 months in combination are going to be very significant. Now, why I think it's worth highlighting the fact that these barrels might not specifically discharge in this month is because, as Omayun was referring to, there are very significant congestion issues in the oil markets, with vessel delays going from kind of 5 days on average up to kind of 12, 13 days average waiting time in many areas of China. So it may not actually happen in July itself, but July and August are going to be very big. I think what you could see from the loadings from the US though is that this isn't going to persist. So even before we were starting to get kind of more concerned about what was happening in the US-China relationship, we're already seeing a decline in loadings going kind of happening in the US due to discharge in China. So that has already turned, basically. I think where it could get interesting is if what you see as we had a few years back, where the Chinese government imposes tariffs in a very kind of short order, and you could see, given how much we have on the water, you could potentially see kind of distressed cargoes looking for new homes. And we have seen that in the past with regards to Chinese imports. I think what's interesting around here is looking at like those LNG and the LPG arrivals as well. Certainly LPG had a full year with basically nothing being imported into China from the US, but now we're seeing those good volumes. And again, same with LPG. We had a bit of a spike in May. That has slowed down now though. So we are seeing those LNG imports into China slowing down. I think what's very interesting takeaway here as well is, despite the fact that we saw from the US this overall reduction in coal exports, this kind of very significant hit in coal flows from the US to India, as Alex was referring to as well, we have seen this kind of stabilization of movement of coal from the US into China. So that is still moving. So I think it's kind of quite a key chart here, just to kind of see from the Chinese side of the equation how much they're importing here. So I'll finish off with just a quick summary, and then we can run into any questions as well. So ultimately, as Omain was referring to, the OPEC Plus agreement has worked. There has been a significant reduction in supply from those countries. That has flowed through into a significant drop-off in oil on the water. That said, we're still seeing inventories, kind of slight draws globally onshore. That said, China is still building, and we're seeing this floating storage not going away. But again, it's just basically moved into China, which is trying to onshore all of these additional volumes. Seeing the US return to a net exporter from crude, slight uptick in production against that decrease in imports, as they've now absorbed all of those additional Saudi barrels. And again, clean products are really kind of benefiting from that uptick in Latin American requirements as well. So on the gases side, LPG has stayed resilient, or declined in May and June, but is looking to a decent pickup in July, with the whole LPG market, kind of the global petchem market, supporting those flows basically. What's interesting is that whilst we see the US now move to the second place in terms of a global olefins exporter, as we were referring to, that kind of on-purpose PDH production, or the kind of propylene production in Asia, the ramp up of rates in Asia, that could potentially reduce the ARB economics for the US at a time when they're increasing their infrastructure for exporting. And then finally, that kind of the LNG and the coal side, where we've just seen this failure to expand or kind of to return to an export market, given, yes, you have global demand concerns on coal, but then with LNG, you also have the additional factor of competing producers actually increasing their output. So at the same time that the US has been reducing its LNG exports, Australia has remained stable. There's been a slight downturn in Russian exports, but in actual fact, Qatar has significantly increased its exports over the course of the last few months. And then obviously there's that kind of summary slide of what you see happening with the Chinese offtakes as well. So that rounds off the webinar, but that gives us some time to run through some questions. And the first one I'll pose to Alexandre, actually, looking at US shale. So do you expect US production to bounce back to where it was previously? And kind of if it does, when do you think that could happen?
Yeah, that's a good question. It's also interesting because we just had the first US oil companies that published their Q2 with some comments. And regarding what they are saying, it doesn't look like that we'll go back to the level the U.S. production had before for a while. So we are speaking about probably 18 months or even 2 years. And that, of course, depends on the stability of oil price, because what is needed now for the U.S. shale oil is some oil price at 50 probably to drill and frack a well, but a stabilized price at that level. In a very short term, you could see an increase of production because you have a lot of uncompleted wells. So a part of the cost has already been spent, which means that at 30 or 40, it could make sense for them to get some cash and frack those wells because the cost is lower than the price today on the WTI. So basically, there is probably a rebound coming right now and accelerating this summer thanks to uncompleted wells, but I do not expect to come back to the level we had at the beginning of the year in the next 18 months.
Excellent, thank you. So I'll take the second question actually, and it's coming back to a point I was just running through on China, and it's saying what was the logistical issues in China preventing the full of floating storage, and that kind of ties in with, do you anticipate a change in Chinese inventories and congestion? So I think just to clarify what I was saying earlier, the way that the volumes of crude oil that China as a whole has imported over the last few months have been phenomenal. Kind of the last couple of months, every month they've set a new record import level, and that is obviously having ramifications in terms of all of the downstream logistics, the inland logistics. As I was saying, we still see Chinese inventories building, but the homes which that crude can kind of end up in are increasingly harder to fill. So I think it's going to be difficult to see a change in kind of the congestion that we're seeing unless things start to divert out of China. This is also particularly true when we are now hearing reports of reduced refinery runs domestically, kind of mediocre demand domestically as well, and no real export market for a lot of products as well. So if those barrels are determined to go into China, it's going to be quite a long time, I think, before they can be properly digested. And that's why I think, referring to these US barrels, they're going to take kind of the rest of July and definitely into August to clear. So I think just got time for one last question. And actually for Armayun on the OPEC side, actually, how much longer do you think OPEC Plus is going to continue its cuts? And if you don't, then how do you see the effects on the shale production? So I think we've probably kind of covered the shale production. So Armayun, what do you think on the OPEC side of the equation?
Yeah, thanks, Alex. No, I think it's an interesting one because obviously the two sides of the equation are linked together. So if prices get up to a certain extent, then as Alex said, we should expect shale production to boost. So the two sides of the equation are quite linked. Now with OPEC Plus, I mean, it's the deal that was reached in April. For the moment, says that until April 2022, OPEC Plus should implement cuts. Now the cuts are going to ease little by little. So from the 1st of August, we should see 2 million barrels per day, as per the deal, being able to get back into the market. And then from the 1st of January 2021 until April 2022, we should see another 1.7 million barrels per day get back to the market. Now, looking at OPEC Plus cuts, I think there's a few things to bear in mind. The first one is that OPEC Plus, I think, as an organization, thanks to this deal, has managed to restore its credibility. I know that because of what happened back in March and April with Saudi and Russia starting that oil price war between themselves, there was a lot of work to be done. But it's fair to say that they have managed at least to restore that credibility. So I would expect them to try and comply as much as they can, and I think it's quite fair to expect them to have a high compliance rate. But the key issue again is going to be the emphasis that is put on legates, whether these countries are able to increase their compliance and especially to overcompensate. That remains to be seen, and I don't think that here we should hold our breath.
Excellent. Thank you, Amin. Well, that is all the time that we have for questions. I'd just like to say thank you for attending our webinar today, and we look forward to you joining us in the future. Thank you very much.